Hey everyone, and welcome to today's Explainer. I am absolutely thrilled you're here because today we're going to decode the foundational language of business. Seriously, whether you're running a massive international corporation or just daydreaming about starting your own little side hustle, there is a universal system that makes the whole shebang work. Today, we're going to focus entirely on the simple math behind profit and break down the absolute basics of accounting so that literally anyone can understand it. Okay, let's dive right in. Have you ever stood in a super busy store and just wondered to yourself, how did this shop owner actually know how much money they're making every day? Or how a giant tech company keeps track of millions of dollars coming in and going out without totally losing their minds? I mean, from the outside, running a business can look like total chaos. And honestly, if you don't know if you're actually making money, you're flying blind. Well, that is exactly the problem that accounting solves. To keep things super simple, here's our quick roadmap for today's explainer. We'll start with the language of business, look at money in and money out, tackle the simple math of profit, define what you own and owe, uncover the golden accounting equation, and finally look at accounting in real life. Let's get to it. Part 1, the language of business. Why do we even need a system to track all this money in the first place? Picture this. You own a bustling local grocery store. Think about the sheer volume of daily chaos happening around you. Customers are constantly walking in, buying dozens of different products. But at the exact same time, behind the scenes, you're buying more stock from suppliers, you're paying electricity bills to keep the fridges cold, you're paying your hardworking employees. You get the idea. Without keeping proper, organized records of all this movement, it would be practically impossible to know if your business is thriving or if you're just quietly running out of cash. And that brings us to a really powerful idea. Accounting is the process of recording, organizing, and truly understanding financial information. It's quite literally the language of business. By organizing this massive puzzle of information, accounting helps business owners make much smarter decisions. It makes sure they pay their taxes correctly, and, maybe most importantly, lets them accurately plan for future growth. Moving right along to part 2, money in, money out. Let's introduce the absolute fundamental building blocks of our profit math. First up, let's look at the money in. Income, which you'll also hear called revenue, is simply the money a business earns by selling its products or services. To make this concrete, if a customer walks into that busy grocery store we just talked about and buys groceries worth, say, 500 rupees, boom, that entire 500 rupee amount becomes the shop's income. It's the raw cash flowing right through the front door. But on the flip side, we have the money out, which we call an expense. Expenses are just the unavoidable costs of running the business because, you can't run a grocery store for free. So buying those products to actually put on the shelves, paying the monthly rent for the building, covering the electricity bills, paying your employees, these are all classic examples of expenses. A solid business records both its income and its expenses every single day. So it's essentially a constant tug of war, which is the core dynamic of every single business on earth. You have your income, the money earned from sales, constantly battling against your expenses, the costs like rent, bills, and stock. Keeping track of this back and forth is the foundation of all accounting. Part 3, the simple math of profit. Now we get to put our income and expenses together to see if we're actually successful. Let's say our little grocery shop has a pretty good day and pulls in 1,000 rupees in sales. Awesome, that's our income. But during that exact same day, the shop has to spend 700 rupees on various expenses, like buying more stock and keeping the lights on. To find out how the business actually did today, you just subtract those expenses from the income. And the magic number is what remains. 1,000 minus 700 leaves us with exactly 300 rupees. This right here is called profit. Profit simply means the business earned more money than it spent. That 300 rupees is the owner's hard-earned reward for running the business efficiently. Now, what if things go the other way? If your expenses somehow become higher than your income, the business experiences a loss. If you spent 1,000 rupees to run the shop today, but only made 700 in sales, well, you're losing money. Every business on the planet has the exact same goal: pump up those profits and minimize those losses. All right, part 4, what you own and owe. Let's shift our focus away from the daily cash flow and look at the overall long-term health of the business. So every business has valuable things, and almost every business has debts. Let's compare them. First, we have assets. Assets are simply things a business owns. This includes the cash sitting in the register, the store computers, the shelves, the delivery vehicles, the building itself, and all the actual products sitting there waiting to be sold. Then we have liabilities. Sometimes businesses borrow money, maybe from a bank or from their suppliers. The money they still need to repay is a liability. Honestly, the absolute best memory trick for this is just assets are what you own and liabilities are what you owe. Part 5. The golden accounting equation. Let's introduce the single most important rule in accounting that ties all of this together perfectly. Behold the golden accounting equation. Assets equal liabilities plus owner's equity. This is literally the bedrock of business. What this formula beautifully explains is that absolutely everything a business owns, its assets, has to be paid for somehow, right? It's either paid for by borrowed money, which are your liabilities, or it's paid for by the owner's own investment, which is what we call owner's equity. Think of it like a giant pie. If a business's total assets equal a complete pie worth 1 lakh rupees, and we know the business owes the bank 40,000 rupees, that's the liability slice, then the remaining portion, the owner's true share of those assets, must logically be 60,000 rupees. 1 lakh equals 40,000 plus 60,000. This equation always stays perfectly balanced, no exceptions. Finally, part 6, accounting in real life. Let's bring all this abstract math totally down to earth. Think about a student starting a classic lemonade stand. Step 1, they start with 1,000 rupees of their own saved up money. Step 2, they head to the store and spend 300 rupees buying lemons, sugar, and cups. Those are our expenses, right? Step 3, during a hot afternoon, they sell out of lemonade and earn 700 rupees in income. Every single purchase and every single sale gets written down in their notebook. By tracking everything, the student always knows exactly how much cash is in the jar and whether this lemonade stand is actually a viable business. Okay, before we wrap things up today, it's time for a very quick pop quiz to test your active learning. Are you ready? First question, what is the money earned by a business called? Do you remember? And second question, what are the things a business actually owns called? Think back to that memory trick we just talked about. Got your answers locked in? Let's see how you did. Money earned by a business is income, and the things a business owns are called assets. Let's quickly recap our core formulas one last time so it really sticks. When your income is greater than your expenses, you make a profit. And the ultimate golden rule of business health, your assets will always equal your liabilities plus the owner's equity. And there you have it. You've just learned the simple math behind profit and the basic building blocks of the language of business. From a kid's lemonade stand all the way up to a massive international tech giant, these exact same simple math rules are used every single day to track success. Great businesses really do begin with good accounting. So I'll leave you with this. The next time you buy a cup of coffee at your local cafe, I want you to ask yourself, is the money you just handed over helping to pay off their liabilities, or are you padding the owner's equity? Keep learning, stay curious, and see if you can spot these cash flows out in the real world. Thank you so much for joining me for this explainer, and I will catch you in the next one.